Good evening and welcome to my live stream. We are showing the market close heat map here after the market closed. It's been closed for a couple of hours. And today was a day when maybe we started taking a little bit of medicine because the market has just been going up, it seems. We've got an expensive stock market. It's gone up really nice, really nicely for these big caps. And in general, the market's up really well here in 2025, following in a year in 2024 when stocks were up and 2023 stocks were up. So we have a little room to kind of give up some gains. So seeing Nvidia drop 2.8%, I don't think that's a big concern. Amazon down 3%. Meta down 1.28%. Some of these big caps, Tesla was down, Visa was down, MasterCard was down, Microsoft was down. These big caps really moved the market. And I don't know that it's a big worry at this point. Is this going to be the beginning of a bigger sell-off? I don't know. I wouldn't be surprised if it was. Wouldn't be surprised if we rallied. What is interesting is there was a rotation into some sectors that maybe are underperforming, like energy. Oil prices did go up a bit, and the energy complex kind of caught a bid, and their stock prices rose nicely. So that looks good. Real estate also did quite well. Some healthcare companies did well. J&J, looks like GILD, United Healthcare, CVS. Some healthcare stocks did well today, and so did aerospace and defense. So some stocks did well today, and others gave up some of their gains. But Meta has plenty of room to give up some of those gains. Probably the one that didn't have a lot of room to give up some gains in 2025 is Amazon. Amazon's been lagging all the big peer caps. So we'll see when that stock gets on track. I think it's a terrific business, one that I think is very investable. So that's what's going on high level. Looks like Saeed is on the stream. How are you, sir? Thanks for joining. Hopefully you had a decent day on Wall Street today or trading stocks. It was a day when if you ended up in the green, good job. You were in the right stocks. So I've got a list of stocks that I would like to go over because members have contacted me. So I've got a list that I'm going to go over. You are welcome to suggest a stock. If you're a member, go for it. No extra charge. I cover it. You're not a member, $5 super chat, and we do full analysis on that stock. We will look at the fundamentals. We'll look at, does the business have momentum? Looking at sales growth, profitability, look at free cash flows, look what analysts are saying. I'll do a full valuation on these stocks to see where do I think the intrinsic value is for a company. Intrinsic value, the most trusted method is to look at free cash flows, the future free cash flows for a business. To give you an example, let's take a look at a valuation, and we'll go over Verizon. This is a pretty decent one. And the net present value of all their future cash flows is in this field. And it's based on a model that I've created that looks at the future free cash flows that I forecast based on growth rates, discounting it by a discount rate, and getting to an intrinsic value of those cash flows, adding cash, taking away debt, so we could determine, in my opinion, what this business is worth. So that's what we're going to do with these stocks. I want to know, is this stock priced at a discount or at a premium based on the future free cash flows of the business? I also want to look at the profitability of the business represented by earnings per share, giving the business an appropriate PE ratio, an appropriate growth rate. And I use the same discount rate on when I value a business using earnings per share. I combine the two, taking more of the free cash flow method into account. 2/3 of the weight of the valuation comes from that component. And this is the intrinsic value that I come up with. This is based on what comes out of the books, these legendary investors. Just about every long-term investor looks at free cash flows. So that's why I really depend on it. I also look at earnings per share because most of the market looks at earnings per share. It's what's being reported on earnings. So I think it's good to include it. So that's what we're going to do. If you're interested in that, let me know if you have a stock in mind. Looking at the after hours, the market is trying to catch a little bit of a bid here and rising just a tiny bit. I don't know if it's going to take. We'll see. Eric M. Johnson, good to see you. Thanks for joining. Looks like you're joining on X. All right, so let's get into the first stock that I wanted to cover. And this was a nomination from one of our members, and it is Oddity. Oddity Tech operates as a consumer tech company that builds digital-first brands for the beauty and wellness industries in the United States and internationally. It serves consumers through its AI-driven online platform, which uses data science, machine learning, and computer vision capabilities to identify consumer needs, develop solutions in the form of beauty, wellness, and technology. Let's take a look at their website. Man, we got our first super chat. And Lauren, thank you so much. I'm going to review the ones you put on there. Give me 1 second. TTD, the Trade Desk, I believe. And then Dutch Brothers. All right. Thank you. All right. So Oddity, just to finish this one, I believe what you could do with Oddity software is you upload your face and then it could make recommendations based on your complexion, the way maybe the features that you want to highlight. It can make suggestions on beauty products. Hey, you ought to go with this. And I have very little knowledge about beauty products, but maybe the tone, you can suggest these products, eyeliner, all that good stuff, lipstick. It could make suggestions. I think it's a neat idea. Now, it may be a neat idea. Is the market buying it? Well, we're going to look at sales growth and see if the market's buying it, if the market likes the idea, or if it doesn't. This is a small cap, 3.4 billion, revenue $751 million, net income $110 million. So it is profitable. PE ratio looks a little high, but it depends on growth. If they're growing fast, that's not a problem. That PE is fine. So this stock really rallied here in the April timeframe when a lot of stocks were in rally mode. It has come down from its highs. It was way up there at $77 a share. It's right now trading at 61. Interesting. Over the 5-year, it's up 74. It looks like these guys IPO'd maybe a year and a month or two ago. So this is a newer business. All right. Looks good. Looks interesting that the market is pricing this stock up. We have growth on the revenue line. Now, this is an important line. If we have revenue growth, that means that the product is being bought by the market, by consumers. People like the product. And 26% is a decent growth rate. They are a little small, but it's a very good growth rate, 26%. Be nice to see like 40%, 50% when they're this size, but 26% is fairly good. Now, so Sales growth is good. Let's see how profitable this business is. That's another important characteristic of a business. Now, they're rather small and they already have gross margins of nearly 73%. Those are very good gross margins. They have operating margin 16%, profit margin of 14.65%. This is a software-like company. If you add profit margin 14.65 and your growth line, which is 26%, you get just slightly above 40. That's a magic number where if the business, a software business, you add the revenue growth plus its profit percentage and you get above 40, it's a distinction that's a good software investment. That's a very good ratio. This is a smaller business. So this looks really interesting. I look forward to valuing this stock in a few minutes. So this looks really good. Really good fundamentals. Let me note a few pieces of information. We've got 130 million of free cash flow. Let's take a look at the balance sheet. It's really important that you invest in companies with a solid balance sheet. A balance sheet could be a sign that a business has a lot of problems. In this case here, we got almost no debt and a pretty good war chest of cash, $678 million of cash, $22.85 million of debt. They could pay off that debt pretty much immediately. So that looks really good. Good balance sheet. So I'm going to look at the forecast. And before I do that, Saeed, I'm going to go over TWLO, sir. And Trader Prad, it's always good to see you. Thanks for joining. Good luck with your stream later. All right. So we've got 10 analysts covering Oddity. And some analysts are optimistic that it could go up to $90 a share. The downside, it could go down to 50. Downside risk isn't too bad. They're just at $61 a share. Let's take a look at the forecast they have for this business. We've got 9 analysts contributing to a consensus forecast. And next year, we're getting closer to the end of 2025. So I'm looking at next year. They're going to grow at 20% and almost reach $1 billion in revenue at the end of 2026. 2027, they're going to keep growing and keep growing in 2028. That looks solid. I don't think they're breaking any records. They are a unique solution and proposition in the market. That is really interesting. Their profitability is going to expand nicely. They're going to continue to be profitable. So collectively, I'm impressed. This is a newer business, a younger business, a smaller business. And they have a couple of things that I like. They're growing the top line. They're profitable. They generate free cash flow. And they're going to expand in the future. They have a terrific balance sheet. I'm liking everything I'm seeing. So let's get into a valuation of this company. Evaluation is important so that we know, would I be buying this stock at a premium or at a discount? Now, it's not enough to find a really good business that you think, man, that's just a terrific business. That's part of it. I think this is a neat business. I'm beginning to form a positive opinion on this company that they have a good business. But now we have to determine what would be the right time to buy it. And that's why I want to do intrinsic value calculations. So we know, hey, where would I be willing to buy this stock? So let's start doing some work. I'm opening the stock analysis website on another screen that you guys can't see. So I could refer back to that while you guys are watching what I do on my model. Now, I don't have anything there for Oddity, but I have other software stocks. Let's go with Wix. I like Wix. We looked at Wix, about a month ago, and I bought the stock. I liked it so much, and I'm up like 35%. So the community that watches this comes up with great ideas. Maybe Oddity is going to be the next great idea. Let's take a look. Let's do our homework. All right. So what I'm doing is I'm copying this model that I created. This model is using basically the calculations you would study if you studied finance in college. You'd probably go over these valuations. I studied accounting, which had a lot of finance in it. Or you could, really just study online. Anybody can learn how to invest and do calculations now. You have this powerful YouTube university where you can learn so much, and you can learn from other investors. You can pick investors or teachers that you really identify with, that you think, hey, I really understand how they communicate. So all these calculations, I'll go through them. It's really important you learn them. You learn them just like, hey, got to have a skill to invest. And some of these numbers you really got to understand. So it's just really second nature to you. All right. So let's keep rolling here. We got a trailing 12 months number of $130 million. They're growing their top line revenue by about 20%. Very efficient business. It's expanding their profits. So I'm going to go with 17% growth on that top line. I didn't go to 20 because I like to be a little conservative. If I'm wrong and they do even better, that's okay. But I hate being too optimistic. And then maybe I had happy ears or happy eyeballs, and I drove too high of a valuation on a stock. On these lines, I add cash and I take away debt. And I think that's a very equitable way of saying, okay, here's what your cash flows are worth. And I'm going to give you credit for all the cash you have, but I'm going to take away value for all the debt you have. So if you have a high debt company, it's going to be less valuable. No debt company, like this case here, they keep all that net present value of cash plus the cash on hand. Let me change my share count. Share count is 55.83. And we have a stock that has a 37% discount, and that's based on a discount rate of 9%. It is a smaller business, but I'm going to go to 8.5. Wix was at 9%. Interest rates are falling. I'm going with 8.5. Earnings per share. Now, I forgot to note that number, so let me go back to my forecast. And I can pick that number up and put it in our model. And I'm going to use earnings per share for 2026 because we're so close. When you look at these numbers, always remember you're looking forward. You're trying not to look in the rearview mirror. It's all these numbers looking forward. That's why I added a growth rate to the trailing 12 months of 17% there. And here I'm going to use the earnings per share. Looking forward, looking at 2026. Now, they had a higher PE, as mentioned, for the current year of 36. They're growing nicely. Now, I hate giving big, bold numbers out there, so I'm going to go with a 28. And the growth rate looks about right. Change it to 17. So Oddity is discounted by 38%. This is an attractive business. This is a buy in my book. And right now we have a little bit of a sell-off, right? The market's been pumping. It's been going up. And I'm going to open up the NASDAQ because this is a smaller business that probably fits better with the NASDAQ or the Russell. And you see that the NASDAQ over, call it 3 years, is up 115%. It's been a fun ride. Now, it's been so fun and so nice that, I'm expecting that we got to have some kind of pullback here in late September and in October. So maybe knowing that this stock is priced at a discount, I'm going to keep my eyes open for Oddity to sell off and maybe catch it at a 50% discount. This stock traded up slightly. It's trading down. So I'm going to think about it overnight, give myself a nice buy price, and set an automated buy if it hits that price. But this was a good suggestion. I think it was Mike who asked me to review this stock, and I'm glad to do so because it's a really good idea. Thank you, Mike. So that's Oddity. Now let's get back to our list here. Looks like Mike is on. So Mike, good to see you. And it's a premium discount. Well, in my book, it's discounted. I mean, it's positive. But sometimes I use the word premium, that you're paying a premium when a stock is priced too high. So not to mix words too many times. But I think it's a good stock. I'm glad you brought it up. I'm going to remind myself to go update my watch list here with Oddity. And then we're going to move on to the next couple of stocks because we've got a group online that wants to check out some stocks. So give me 1 second and then we will get moving on the next stock. All right. So next stock we're going to look at is the Trade Desk, I believe. Yeah, the Trade Desk. Now, this has been a really interesting space, which is the ad tech space. And we've looked at AppLovin, we've looked at Trade Desk, we've looked at Zeta, Viant. This space is like, it's relatively new, right? Companies are advertising online on Netflix, Facebook, Instagram, TikTok, YouTube, right? And this is a new thing. And companies that advertise like the Coca-Colas, Nikes, and so forth, they want the best technology to enable them to get the best return on investment when they advertise. One of the companies out there is the Trade Desk. And they give the customer, the user, the ability to do ad buying. In their opinion, they really get really good ad buying done for customers. This stock has not had a fun ride for the last 12 months. It hit a high of $139 a share back in December, and it's trading at 46. That has been a little punishment, maybe a lot of punishment for investors. Not fun. And some of these steep, drops after earnings, those are really catching my attention. What's the investing community disliking about Trade Desk? Why is it trading at 1/3 of the price it established last year? So let's take a closer look. I believe I have a valuation on the Trade Desk, but I want to go step by step. Lauren, thanks so much for sponsoring this. I don't know that you've posted before, so it's great to see your name. Thank you for attending and thanks for sponsoring this. So we've got a company that has a $22.91 billion market cap with revenues of $2.68 billion. When we look at PE, the PE looks a little expensive for the current year. Next year looks pretty darn good, 24.7 if they're growing. Analysts feel that this is really discounted. The market's selling the stock off, and the analysts are like, hey, our price targets are much higher. So we'll take a look. So the business is growing quite nicely, 23%. We just looked at Oddity. Oddity is substantially smaller, and they were growing in the 26%, I believe. So for a business to be 2.67 billion in revenue and be growing at 23%, that's pretty darn good. That's good. Now, these guys have a pretty good gross profit number. So when we look at gross profit, 79%, that's very good. Profit, 15.57. And again, if you add 15.5 plus what's their growth rate, 23.18, they are just slightly below a 40. I think if I add those two numbers in my head, we're at 38. Pretty close to being in that category of 40 and above is a very good investment in a software company. Pretty close. Profit margin's decent at 15, especially if they can grow. And the gross margins are excellent. These are really good gross margins. That's why I invest in so many software companies. I love these margins. All right, that looks good. We got a free cash flow number of $755 million. All right, so cash flow looks good, and you see the growth in this cash flow. When you have cash flow growing at this rate, it shows that they have a product. They don't have to put a lot more money into it. It's hit a maturity level where they get to reap a lot of free cash flow from that product. Looks good. So always double checking to see if the balance sheet is good on every single business. Let's take a look at this one. These guys have cash of 1.69 billion and debt of 343. So they could pay off debt immediately because they have a lot of cash. Looks good. Now let's take a look at the forecast. What are analysts saying about this? Now we have a lot of analysts covering this. That's good. That means we have a lot of data, a lot of opinions, and so forth. Very little downside risk because the most pessimistic analyst believes this is a $50 stock and the stock's at $46.86. Most optimistic analyst believes you could triple your money. That sounds pretty nice to me. Okay, so we've got a forecast that they're going to keep growing. That looks good. And they're going to be trying to be a $5 billion business at the end of 2028. That looks terrific. Earnings per share is going to grow nicely. Very good. So looking at 2026 numbers, next year they should grow 16.75 and have earnings per share of $2.11 per share. So that looks good. And their PE is dropping over time. All right, so that looks good. These numbers look good. It's one of those things, and when we looked at the trade desks in the past, is what did the market hear that it didn't like around their earnings? Let's see if we can grab that and refresh my memory. So I think Amazon is expanding its ability to help customers do ad buying. So that might be a risk factor. As soon as Amazon gets mentioned, it seems to really cause a lot of fear in whichever company's operating in there. Now, I'm an Amazon stockholder. So this is it. Netflix and Amazon, these big platforms are trying to go to their customers and say, you don't need these third-party trade desk apps. Go direct with us, and you're probably going to do better in buying your ads, and you can avoid the cost of what these guys are charging. That sounds pretty good, but I would be the first one to say Netflix should stick to creating content and delivering the content. Amazon should stick to, in the case of Prime, or even on their e-commerce platform, is Amazon. You already got plenty to do. You guys should really focus and obsess on being the best Amazon e-commerce company, as well as a streaming company. You try to do too many things, it ends up usually with a bad outcome. So that's what's going on. There's some fear that Amazon and Netflix are going to come into this space and take some of Trade Desk's revenues. I don't believe in that. I don't. If you looking at the situation, I would actually bet that the Trade Desk is going to continue to operate, because Amazon and Netflix, it may be true that they want to go into the space, but pulling it off and achieving what they're looking to do is going to be really difficult. All right, so let's take a look at my valuation. So I like the company. I like the growth rate, good profitability. The stock is beaten down. So this may be setting up quite nicely, right? I make money when I buy a stock, oftentimes when the company hates it. And I said the company, the market. The market hates a stock. Let's go over an example, just a real quick one. So let's go over Google. That applies here. And the market for a long time was like, man, Google is just a bag of hammers. Gee, just throw it out. Sell it on the next garage sale. Down 29.43%. And that was a terrific opportunity. There's a lot of doubters on Google Alphabet, doubting their AI business, doubting their search business, doubt. And of course, you had the Department of Justice on their backs. And the Department of Justice issue went away. Gemini is number one. I was using it earlier today. I was really impressed. And the stock has rallied 72% within 2025, intra-year, a rally of 72%. So I love when the market is kind of just irrational, selling off stocks. Are we going to see that opportunity with the trade desk? I don't know. But it's sure reminding me of what we saw with Google, among others. There's other companies that have been sold off by the market. And, you know, it's not about fair and what's fair and not fair, what's right and wrong. It's about making money. And hey, if the market wants to discount the trade desk or Google or United Healthcare and I can make money, beautiful. I'm good with that. So as I speak, I think that the trade desk is discounted by 30%. That's a very nice discount. And especially if we see a nice sell-off in the market, wouldn't be a bad stock to take a look at. Now, is this compelling? Let me cover one more area, and then I'll answer that question. I want to compare the trade desk to its peers. And I have a video where I compared ad tech companies. So I compared AppLovin to all these companies, including Trade Desk. Take a look at that video. Zeta provides a 30% discount. I'm an owner of Zeta stock. That's the same discount available. Okay. And then we've got AppLovin is priced 11% too high. I'm an AppLovin stockholder. This stock's just been on a tear. Just number one player in the space, much larger than the trade desk. It's got a market cap of 218 billion. Zeta is a tiny little stock. It's 5 billion. Then the trade desk is down here at 22.9. We also have Viant, which is tiny little company with a market cap of 568 million. So I think the trade desk is a very good investment opportunity. If the market could give us another 5% discount, that'd be great. And I think that the market's going to be wrong about how dangerous or threatening the whole Amazon Netflix thing is. Again, I've heard that story before. I've seen that movie before. It usually ends with the companies that have the specialization win. The ones that obsess on being the best ad tech company, period, win. Not the big conglomerate that has 500 different things they're trying to do and they figure, no, we can do this as well. No, usually doesn't work. So that's where I'm at with the trade desk. Good business, very investable. And let's take a look at one more thing while we're on trade desk. We're going to go trade desk on Google, and we're going to compare it. We're going to compare it to AppLovin because AppLovin is the leader in the space. We're going to pop Zeta in there. And then we'll pop Viant. Viant's a tiny little company. So then we got kind of a small, medium, and large, and extra large, I should say. And when we look at these over the last year, you see that AppLovin's just been performing just really, really well. It just really took off and has really left all the other businesses behind. from a market cap perspective. If we look at the rates of return for the 1 year, you see that AppLovin's been cleaning up 416%. Yeah, baby. But it's priced really high right now. Now that leader, they got there because they probably have the best solution. Now I want to show this because as you think about investing in the Trade Desk or Zeta or Viant, just be aware these guys are number one for a reason. Their technology is probably better. Customers like it more. They've just been killing it. And if you look at their growth rate, they actually accelerated their growth rate. They're much larger than the Trade Desk. They're growing at 72%. Trade Desk was growing at 21, 23%. So AppLovin is the A+ valuation company in the space. Just be aware of that, hey, these guys are going to have to be more competitive, be realistic about, is AppLovin going to take over the world here? So I wanted to show that just so that you have that knowledge as well. I appreciate you asking about the Trade Desk. Now we're going to talk a little coffee and talk about Dutch Brothers. And I have a little soft spot in my heart over Dutch Brothers. Family trip. Geez, this was like 15 years ago. We were touring Oregon. My kids were little. And on that trip, we went through a Dutch Brothers. And they were really nice to us. In fact, we were there for the first time. They said, well, your first time drinks are free. We were like, wow, man, I love this place. So I remember that experience. And they were a tiny company then. Now they're public. That's great. Now, I don't like restaurants. Restaurants, when we get to the margins, you're going to see we just covered 2 software businesses. I like software. I love software businesses because of their margins and their ability to grow quite quickly without much capital. Dutch Brothers, they're similar to Starbucks. They have a lot of drive-throughs. They are headquartered in Oregon. As mentioned, we were in Oregon 15 years ago and enjoyed some Dutch Brothers back then. Market cap, $9.8 billion, revenue, $1.45 billion. PE ratio is really high. And these guys IPO'd recently, I believe. Yep. Back in September. Is that right? Yeah. And that's they IPO'd a year ago. Now, the stock overall is up 58%. Interesting. Okay. Now let's take a look at their growth rate. They are growing. Now it's important to see here, and we're going to go to their financials off their website, are they growing same store sales or are they opening new locations? If you're growing same store sales, same location sales, that's really good. I don't think they're growing 29.8% same store sales. If you're growing by adding new locations, it might prove to be really good, but it's not as good as organic growth in the same location. So let's keep looking, and I'll try to get to how many stores are opening. And let's keep going. I think ratios might get me that on this website. All right, so let's drop down to free cash flow and margins. Now, we have been talking software, so we were talking 70, 80% gross margins. Now we're with a restaurant. We're down to 26.7% gross margins. I don't like these margins. I like their coffee. I just don't like the margins. Why is it so low? Well, think about it. Every time somebody orders a coffee, you have to have an employee behind the counter or behind the window that's going to make that coffee, somebody take the order. So you have a lot of labor involved in just operating the business. Every single location has employees behind the counter. You also have direct materials like premium coffee. Got to have that premium coffee, right? You have whipped creams and milks and all kinds of stuff. And that's what's taken away that profit. And the net profit is 4%. So we're dealing with a good growth rate, looks good on top line growth, but these margins, don't like it at all. That's why I don't own any restaurants. These margins, I just can't warm up to them. So that's what's going on there. Let's see if I can find the number of stores and see if we are growing the number of stores, or if, here we go. So give me a second here. Let me try to get my bearings straight. So I think this is the number of stores. Shops by type. So these guys are growing the number of locations, and they are franchising some of their locations as well. But you can see that they're adding locations, which is, might be really good, but it's not as good as, hey, using the same locations, we're just growing much faster. And I showed you the profitability of this business. Let's go over the balance sheet to see if they have any debt. If they do, how much? And you see that they have $980 million of debt and a little bit of cash, $255 million of cash. So I think their balance sheet's decent. Debt to EBITDA, 3.33. That is higher than I like. I like 3 or under. That's a little higher. So it's kind of a C- passing grade, but it's not an A+ like some of the companies we saw that had lots of cash and no debt. So this one here is a little bit concerning. So this stock here is pretty much a sell, a pass for me. I just can't warm up to those margins. And there's a couple of things that are involved here. Now, if you love restaurants, you should invest in restaurants. If you really understand restaurants, be a master of that market. But if I get myself involved in a Dutch Brothers, then it takes away my time from potentially buying into a software stock like Oddity. And I think I can make a lot more money down the road versus buying into a restaurant. Now, let me take a look and hit you with the ratio, and then we'll move on from this one here. So we have free cash flow of $73 million. Okay. And we have a market cap that is almost 10 billion. Oddity, on the other hand, has a market cap of roughly 1/3 what we just saw from our friends at Dutch Brothers. And their cash flow is almost twice as high. So you see how profit margins really measure up. So investing in the right industries is really important. Getting to know industries that have just built a lot of wealth for a lot of people is key. So I hope you found my analysis of Dutch Brothers interesting. I like the company. I like their coffee, but I just don't want to be an investor. I'd rather be an investor in high tech, technology, communication services, really high margin businesses. And if I do a valuation on this, I'm going to show you that it's priced too high. So thanks for asking about Dutch Brothers. All right, so we're going to keep moving here. Saeed. You want to go over TWLO. That's Twilio. Twilio, together with its subs, offers customer engagement platform solutions in the U.S. internationally. It operates through 2 segments, Twilio Communications, Twilio Segment. The company provides various application programming interfaces and software solutions for communications between customers and end users. All right, so we're going to talk a little software. Let's take a look at their website, kind of get familiar with the company. So these guys are in the customer experience space, otherwise known as CRM or service, automation software. This is the space that you are competing against the likes of Salesforce, ServiceNow, and others. Okay. All right. Let's take a look at their products. So you can build a platform so you can communicate to your customers, using text, WhatsApp, phone numbers. Okay. When you see warehouses, that means, maybe somebody's calling in or going online and asking, when are you going to ship me my product? Okay. All right. They work across these industries. Okay. So I've gotten familiar with the business. Now, one important distinction is, are these guys services or are they a software company? And I'll be able to determine that when we look at their income statement. The margins will tell me if it's one or the other. Twilio is a $15.87 billion market cap company. The stock has worked for the 1 year. It's up 63%. Year to date, not so good. 5 year, not great. It looks like they IPO'd and then they really sold off. But it's had its moments. It's had its moments where it's had really strong rallies. More recently, this is maybe sold off. So let's keep looking. So this company has revenues of $4.73 billion. P ratio is really high. But forward P looks pretty darn reasonable at 22. Analysts think it's discounted by 28%. Now, when we look at their revenue, $4.7 billion, 11.5% growth rate. I like looking at the quarterly to see if we look at the quarterly, are they building momentum or are they losing momentum? And it would be the case that they're building momentum. Each quarter, the growth rate is expanding. That looks really good. Okay. Let's take a look at their margins and cash flow. Cash flow is expanding quite nicely. Look at that, 774. Looks really good. So let me start noting a couple of these numbers because I think I'm going to need them for the valuation. So we got $774 million of free cash flow. So gross margins, this is the line that I wanted to look at. See how this gross margin number is only 50%, where the software businesses that we looked at previous to these were at 70, 80%. The difference is that these guys are not a pure play intellectual property software company. They don't own like a big, or I should say, very popular software and are just selling that code over and over again. They're providing services of some form, and it's reducing their gross margins, making them less desirable in my book. That's why I look at margins. What kind of business am I buying? And you see with that reduction in gross margins, even though they're bigger than Oddity and the trade desk, they're having a hard time making money, getting a profit. At the end of the day, they're just squeaking out a profit. So just be aware of that. These guys are not a pure play software company. They're doing a lot of services, and I don't know that they'll ever be an 80%, 85% gross margin business. I don't think that's ever in the cards. So just be aware of that. All right. So 774 is their free cash flow. They're growing at 11.5%. 26 analysts cover the stock, and they are really split. We got one analyst with a price target of $170 per share. Another analyst way down at 75. So these guys are really spread out. On average, it is discounted by 28.4%. When we look at 2026, their growth rate is really slowing down. See that there? Now, this number keeps getting bigger. I would say that, okay, bigger numbers are harder to grow. But boy, that is a slowdown in the growth rate. Okay. They keep getting bigger each year. And the earnings per share is going to expand nicely. That's good. Earnings per share is dropping. But this combined with lower margins is kind of a double negative, not quite, critical, but just be aware. This business is not as desirable as a pure play software company. All right, so I got some numbers in there that I need. The shares outstanding, 153.43 million shares outstanding. And let's take a look at the balance sheet. Make sure that we've got a reasonable amount of debt. And in the case of this business, that's fine because we have $1.1 billion of debt, but they have 2.54 billion of cash. So we're good there. More cash than debt. All right, looks good. And let me note the earnings per share number before I start cracking open a valuation model. So for 2026, they're supposed to do $5.31 in earnings per share. And that's going to be grown at 7%. Future growth, I'm going to grow at 7%. You see these growth numbers, and that's where I'm getting a 7% number. All right, so we're in our valuation area. I don't think I have TWLO. I don't. So what we'll do is we'll go, Nice Software is in their space, by the way. These guys also do customer experience software. So we can just kind of put them down here. It's in this neighborhood of the valuation schedule. So let's copy this as a template and we will value TWLO. All right, looks good. Okay, so let me update all the information here. We're going to drive towards a valuation of TWLO. So TWLO, and that is one second. I need to take something off the screen. I didn't notice that I had that on the screen all this time. All right. So we're going to go with Twilio here. Twilio is a small business with a good balance sheet. So we're going to go with 8.5. The free cash flow was $774 million. And we're going to grow the next 4 years by 7%. That drives this valuation. We're going to add cash, which is $2.54 billion. And we're going to take away debt. Shares outstanding, 153.43. So it's showing a 21% discount on this business. Let's take a look at earnings per share. EPS was $5.31. This is a growing business. I'm going to give them an 18 PE and grow by 7%. So this gives me about a 15% discount. Some decisions I made, I didn't give them a 24 or a 32 or 36 because of those margins and the slowing down of growth. I can't give them a 24. A 12 is for a slow growth company. 18 is for a moderate growth company. They're profitable. So I'll give them an 18, but I can't go to 24 or even higher. So on that valuation, they're fairly priced, not going anywhere. Free cash flows look a little better, but 15% on a smaller company just doesn't do it for me. I need like a 35% discount in order for it to be compelling. This one here would be a pass for me. I wouldn't buy it. If I owned it and was sitting on a good gain, I'd probably just keep it. But I don't own any, so I wouldn't buy it. I would just really pass on this stock. So I appreciate you asking, Saeed, about Twilio. And hopefully you found my analysis interesting, sir. Thank you for being a regular on live streams. I really appreciate that. Appreciate all the questions you always have. And that is Twilio. All right. We're just humming along, taking care of valuations. Let's move on to the next one. All right. So we got Mike handled Ben 10. It has been a rough year for the trade desk. Yep. Man, changing CFO, shares down 30%. Ouch. That was a tough day. Tough day. Yeah, trade desk. So Ben 10, PayPal is sold off even after the news of the Google deal. And I saw the news release on the Google deal, and I thought it was interesting, but I wasn't sure that the stock should rally on that news because they already developed solutions that, they run on Google Cloud, they run in AWS, they run anywhere. They're a payment processor. They should work with everyone. The stock hasn't really worked. This is a slow grower. It's a value stock. PEs are really low. They have good margins, but their growth, this is where the market's not excited because of that slow growth. They can grow at 10%. I think the market would be more excited. The market just doesn't like PayPal. And that's that. I'm an owner of PayPal. I can tell you firsthand, this has been not good. And you see, coming out of COVID, I did not own it at these prices, but this stock was at $300 a share. Now we're down to 67. Ouch. So PayPal has not been one of my best performing stocks. Zeta has been doing well. I'm glad that I picked up some Zeta. I can thank the person who brought it up on a live stream because the stock has been working. It's been going up. I'm sitting on a decent gain, and this is a small cap. It's a good growing company. Look at that, 40%. Earlier, we looked at a business that was smaller, growing at a lower percentage rate. So I like that growth rate. Now, these guys, can they stand up to AppLovin? Probably not at this time, but so long as they carve out a good part of the market and make it theirs, they're going to be just fine. All right. So Mike and Ben 10 are just lighting up the chat. Thanks, guys. Good stuff. Yeah, AppLovin, it's a tough one to buy because it just keeps going up, but it's number one in their market. And if you look at, where they've been, that 416, right? But look at their growth rate, especially a couple of years ago, they were not growing. And then they figured something out, started to grow. Then they really figured things out. And look at these growth rates. They are dominating this kind of growth rate, and they are much bigger than the other players. That's pretty dominant growth rate. So very, very good performance from AppLovin. All right. So that's AppLovin. De Jesus Real Estate. Interesting. BLDP. Well, I could look at it, $5 super chat, or if you become a member, you could just put stocks on the stream and I look at them, or you can communicate with me and I can look at them. Giving you a quick tour of the different options. You can become a simple value investor on my channel, and then you can nominate stocks and I can look at them. If you want a copy of the model that I've been going through, you can do your own valuations, which a lot of members do. Advanced member, you get a copy of that model. You also get invited to the Discord, and you get a copy of all my valuations that I update like twice a month. It's kind of a repository. You can look them up 24/7. And then if you want even more super investors, you get one-on-one call. You get to see some super investor only videos, just a lot more there. I'm really revealing my portfolio and trades at that level. And then even more at a platinum investor level, if that's something you're interested in. So take a look. If it's something that would be good for you, it'd be great to have you as a member. All right. So it looks like Herdo is on the stream. He wants to take a look at Owl. All right. So what is Owl? Is it Blue Owl? Blue Owl Capital? All right. Let's take a look. Blue Owl Capital operates an alternative asset manager in the United States. The company offers permanent capital-based solutions that enables it to offer holistic framework of capital solutions to middle market companies, large alternative asset managers, corporate real estate owners, and tenants. It also provides private financing solutions such as direct lending products comprising diversified technology, first lien, and opportunistic lending to middle market companies. So these guys are private money, asset management. So they'll probably finance deals and want to have a good return on their capital. They haven't been doing great for the 1 year. They pay a decent dividend, almost 5%. Year to date, not great. Year to date, 1 year looks a little better. 5 year looks pretty good. 73, not great, but not bad. And you get that dividend, so you'd be near at 100% rate of return. So are these guys primed to do well now that we have lower interest rates? Maybe. Let's take a look at their website. Let me get more familiar with Blue Owl. So here it is. So redefining alternatives. At Blue Owl, we are doing more than just investing in private markets. We are shaping the future of alternatives. We serve our investors by being a partner of choice for businesses seeking private capital solutions. Okay. Credit, real estate. Okay. Okay. All right. So I heard something today that I'm connecting with this particular company. We all know who OpenAI is, right? They have ChatGPT, and they want to spend a lot of money. And look, De Jesus, thanks so much for being a member. And we're going to go over that stock you wanted to look at. So BLDP. So let me finish my thoughts on this particular company. So OpenAI, they're not public, and they are going to spend a lot of money in the data center to make their AI platform bigger and bigger and bigger. And they're saying that they're going to take out a lot of debt in order to get that accomplished. Well, that's somewhat what Blue Owl does. They provide that type of funding for a business to grow. So that's an example. I heard about that today and made the connection to this business. All right, we're dealing with a $28.88 billion market cap business. Revenue is $2.62 billion. Net income, $75 million. And we've got a high PE ratio of 163, but forward PE looks really good at 20. Strong buy, 33% discount. Looks like it's been selling off. Now, all this lower interest rate talk that we've seen over the last 30 days hasn't really created a rally in this stock. And I think that's interesting. If their cost of capital is going down, why wouldn't they be making more money? That's just my 2 cents or my logic. Revenues are looking good. Revenue of 31%, growth rate 32% for the full year, 26 looks good. All right. So it looks like they're nice and profitable. Earnings per share is pretty low. It's kind of a low earnings per share. And they do cash flow. Now, I want to take a look at their actual income statement because I want to know, should they be treated like a bank or should they be treated like a Robinhood? And if you're charging fees and so forth, you should be treated like trade fees and transaction fees. You're a Robinhood. If you're lending money out and you're doing net interest margin, you borrowed the money at 3%, you're lending it out at 7%, net interest margin of 4%, then you're a bank. So let's take a look at their actual P&L. So I don't want to, oh, this is like their investor portal. Okay. I don't think I want to see that. So what I'm going to do is type in Al Investor Relations, see if that gets me what I need. Yeah, here we go. Okay, so financials. So I'm trying to get to their P&L and man, this is a lot of reporting. All right. I don't think that's what I wanted. Let's see if I can find, here we go, 10Q. All right, so let me make this a little bigger so it's easier for you guys to read. And I want to get to their financial statements and see how they report their data. So assets under management, that's what AUM stands for. So they're doing credit, real assets, strategic capital. So now I get what they're doing. Okay. So these guys are acting as a platform. And let's say BlackRock's like, okay, we want to offer $100 million of loans for real estate developers. And then you have real estate developers that say, hey, we want to borrow that money. And looks like, BlackRock's willing to lend it. We qualify for that. These guys are basically being the intermediary, kind of getting the lender and the borrower at a enterprise level, a place where they can do these transactions, and they're going to be managing those assets. So this is not a bank. So I wanted to make sure I understood that, because a bank really gets valued differently. Okay. All right. So I've made that determination. Let's get back to their fundamentals. So these guys are providing free cash flow of $1,042,000,000. All right. And they have gross margins of 58%. All right. Net profit margin is pretty low. Wonder why. Very good free cash flow. Okay. All right. So their balance sheet's probably going to be a little unusual. Here's debt, 3.65 billion, cash only 117, because they're probably borrowing to fund some of these deals, probably short-term liquidity. And debt to EBITDA is right at the limit, 3.08. So I'm okay with their debt level, but just be aware it's going to have a higher discount rate because it has a greater amount of debt. All right, so let me note these numbers. All right, so let me note the earnings per share. Let's take a look at this. So one analyst has these guys at $32 price target. One analyst has them at 21. So they all believe that the stock is discounted just by how much is their disagreement. They have for 2026, they're going to be $1.04 in earnings per share. They're growing 22%, 17 and 20. That looks good. They grow earnings by 15% just to play it safe and to be conservative. When we look at their shares outstanding, 1.55 billion shares outstanding. All right. So these guys, I haven't valued a company exactly like them, but we have other companies that are in the financial space that do these kinds of, or I should say that collect fees when there's transactions happening. So let's go with Robinhood and kind of look in that area. That's where I keep a lot of these companies. So I'm going to put them right next to Dave. Dave is a financial services company. They're more consumer facing as opposed to OWL is really putting together business to business, right? You have a lender that's ready to lend out commercially. And then you have these businesses that are looking to grow or looking to do some type of transaction and need funding at a commercial level. All right, so remember the balance sheet wasn't great. So I'm increasing my discount rate, taking a higher risk. Got to pay me more if I'm going to take a higher risk. So we are going to put in our free cash flow number. And that was $1,042,000,000. We're going to grow those cash flows in the first 4 years by 15 per. Actually, what were they growing by? Let me take another look. So they're going 31. Okay. Forecast is they're going to grow 22, 17, 20. Okay. So yeah, I'll go with 15. 15. And we're going to go with 4. They're already pretty good size. Cash on the balance sheet is $117 million. They have some debt on the balance sheet. And then their shares outstanding. So on cash, this business is underwater. It's priced 28% too high. Now, I went a little conservative here, but I don't think that's going to make a big difference. And I did hit them with a higher discount rate because I don't like that debt on the balance sheet. It's a riskier situation. They're also not a really well-known company, right? It's a smaller company. So I think that's the right decision that I would make. Earnings per share, we're at $1.04. They're a growing business. 24 is fine. Growth rate of 15%. So these guys, if you combine the two, because I put more weight in the free cash flow method, they're fairly priced. No discount available. This is a neat business, but the market has been selling it off recently, and it's had really interesting runs, right? You've had it go up and then come down over the 5-year. You had a real nice rally coming out of 2023. Stock went up to $26 a share, and it's really come down. So this one here would have to come down substantially more in order for me to be interested. I need to have a compelling discount on this business because the balance sheet isn't perfect. It's a smaller business. So I'm going to just say this would be a watch stock, and I would watch it until it offers a more compelling investing opportunity for me. For now, I would not buy. So there you have it, sir. Hopefully you found my analysis interesting and appreciate it. I keep leaving these messages on. I apologize for that. But Herdo, appreciate you. Hopefully you found the analysis there. So De Jesus, we want to look at your stock now. All right. So where were you there? Let's find. I think it was BLDP was your stock. Okay, so all right, BLDP. Let's do this. BLDP. Ballard Power Systems. And boy, these power generation companies have just been cleaning up. This one here for the 5-year, look at that. It's sold off and it's really caught a nice rally. This is a small cap. Look at that. Wow. Herdo, you are awesome, man. Thanks so much. I appreciate it very much, sir. And De Jesus, great to have you. Do me a giant favor and email me. My email is victorhinvesting@gmail.com. It's on my website, and then I'll get you all set up with, a list of the perks you get. Make sure you get everything that you get as a member. All right, so moving along, we're looking at Ballard Power Systems. And let's get a description and take a look at their website. So Ballard Power Systems engages in the design, development, manufacture, sale, and service of proton exchange membrane fuel cell products. The company offers its products for power product comprising for bus, truck, rail, marine, stationary power, and emerging market, such as material handling, off-road, and other applications. Okay. So let's take a look at their website. So it's like a fuel cell. Okay. So their fuel cell modules can go into buses, truck, marine, rail. Okay. Let's see what buses is all about. So this Champion Zero Emissions. So they use hydrogen to recharge batteries. Interesting. Very cool. And the emission is vapor. All right. That is innovation. Pretty cool. Okay. So I understand the technology. Small cap. Revenue, 72 million. All right. They are losing some money. Not a showstopper. Let's see what we're dealing with. Analysts don't like it. All right. Stock market likes it for the past year. So let's take a look. So they have not had consistent revenues. You see that here. They are beginning to grow, which looks good in the quarterly. We're missing a quarter, but looks like they're growing a couple quarters. That looks good. And they're really small. So that is a concern. They're making a product, right? It's harder to scale up when you're making a physical product. You need factories, you need to buy materials, you need to pay people to manufacture that product at a high quality level. So those are just things that are on my mind as I look at a business like this. It's not like those software companies where, hey, they have the right piece of code, 1 million customers want to buy it. You sell it to all million and you're kind of done. Now here, if 1 million customers wanted to buy this, you got to make 1 million units and ship them out and make sure they're high quality and all that good stuff. All right. So right now they have revenue of 72.5 million, and their cost of making that product, the materials, direct labor, direct burden, is higher than the sale price, which means they're losing at the gross profit level, negative 16.55. They're losing, if they sold the product for $72, they're losing $16 per unit sold. So they are really operating at a loss, which is not good. But let's see if there's light at the end of the tunnel there. All right, so they're not going to have earnings because they're losing money. Free cash flow, no free cash flow. So these numbers do not look good. Let's look at their balance sheet. How much cash do they have left? How many years do they have left of operating and until they're out of money? So they have $552 million. Not a lot of debt. Good. 528. So their burn rate on cash is roughly $120 million. Okay. That's their negative free cash flow. So they have about 4 years to make this business work. Now it's been in a rally for the 1 year, which is good. Now it was kind of left for dead at $1 per share. This is usually where stocks go to die. They just are not desirable. The market, prices them where no big investors are going to buy it because it's a super risky stock. Now it's risen to 292 and it's still a very low price stock. Few investors would be interested. Now, why is the stock rising? Let's take a look. Has there been some news that came out and, they signed a big contract? Let's see. So these guys are in the Canadian stock market. Okay, so this was on the 17th. Okay. Yeah, I don't see like partnerships or, hey, they got a giant customer. Maybe I'm not going back far enough, but let's see. No, these are all annual meetings. Let's see here. So they changed their leadership. Here they got an order from Sierra Northern Railroad. Okay. So I'm not seeing any like compelling news where it's like, wow, they just signed a big contract. So here's their balance sheet. Got it. So here's the revenues. This is for 3 months, 6 months. So they have negative gross margins. Okay. They still are putting a lot of money in R&D. So this is a really tough one to value because I don't even know what their gross margins are going to be. But you could see that this type of industry is tough because just the cost of producing the product is really expensive. So this will always, in my opinion, will be a low margin business. Can they, really start growing really fast? Potentially. They haven't, and they've been around for a little while. So I'm really concerned that, this would be a high risk situation with not a lot of return. I think the big rally was caused because the price of the stock was $1 and it went up to almost $3. So yeah, there's a really nice rate of return there, but that's because it was priced so low. This one here would be a sell for me. It just has too much risk. And I'm not seeing that, hey, there's press releases where, hey, some big company is partnering with them. And in fact, if their technology was really, really good, another business can easily acquire them for not very much money and then own the rights to the technology. So there's a lot of red flags that are telling me this is not a good investment for me. And I couldn't value the stock because I don't have cash flows or earnings per share. So I appreciate you bringing it up. Thanks so much for being a member. And, please keep bringing stocks. I'm sure we're going to be able to value some that have positive cash flow, earnings per share. The investor that I am, right, I rarely invest in companies that are really small unless I'm personally involved in them. I really know them. I like to have businesses. I'm okay with small caps, but I need to see legitimate fundamentals that calculate a value for that business based on cash flows, earnings per share. I want to see balance sheets that are good, in good health. And Ballard just scares me. It scares me. The margins, I don't think will ever be excellent. I think they'll be struggling for a long time. So I hope you found my analysis interesting, and I really appreciate you asking. All right, see here. So let's take a look at KVUE TWLO company. Yeah. I think there was interesting story there. Let's see here. KVUE. Let's make sure that I'm looking at the right one. So KVUE operates as a consumer health company in the United States and Europe, in the Middle East. Self-care, skin, beauty. Am I looking at the right company? On KVUE TWLO company. So am I looking at the right company here? De Jesus. Please let me know. Because I see KVUE here, but I don't know if these guys are a TWLO company. TWLO thought was like a Bayer product, but let's see our brands. Neutrogena. Okay, maybe they are. Self-care. Look at that. Zyrtec. I'm familiar with this. I've taken this when I have allergies. There it is. Tylenol. Okay, yeah. So they do own this brand. All right. We're off to the races. So they have a variety of products here. These are like consumer packaged goods products, right? You got your mouthwash, your skincare. And are these guys a website or are these guys actually manufacturing? Okay, perfect. So through our iconic Kenvue brands, we connect with 1.2 billion people globally. Daily rituals that matter most. Okay. Okay. So they bought some brands that we all have known for years. These brands have been around for a while. Okay, so this is household personal products, consumer staples. This is not a bad category right now since we have an expensive market. And maybe these tech stocks start to sell off nicely. And we have a stock that's really sold off. So let's study the fundamentals here. So this business, market cap 33 billion, revenue 15 billion, PE is 23, forward P is 16, pays a nice dividend, almost 5%. Price target, analysts think it's a buy with a discount of 37%. So they're not growing. And last 5 quarters have been small contractions. So they're not growing. Okay. Staples tend to be this way. They grow very, very little. The best they can do is they grow their profit line. And we'll see if that's happening here. The trailing 12 months, they're contracting a bit. Okay. So I'm expecting lower margins than those software companies we were looking at earlier. But they're pretty darn decent, 58%. This is better than our friends over at Dutch Brothers. These guys are manufacturing a lot of these necessities and putting them out to stores, and then they sell the products. 58% is pretty darn good. I was expecting a lower number. Profitability is good. So that's where these guys could grow, is in the net profit by becoming more efficient. Now, I think there's been a story, right, where I think the current administration was saying Tylenol might be bad for pregnant women and the baby. And then the medical, I don't know who within the medical organizations or institutions came out and said, no, we don't have any science that would agree with that theory. So they kind of were like, hey, we're not changing any of our guidance when it comes to Tylenol. So this one here has pretty decent profit margins and free cash flow margins. So we can value this one and see if it's a good investment. I'm not a big consumer staples investor. I like growth stocks. I like things that are going to potentially, triple my money, 5x my money. But this one here, let's just value it and see if maybe it's compelling. All right. So we have free cash flow of $1,627,000,000. That's a pretty good number. They have balance sheet. So they have $1 billion of cash, $8.7 billion of debt. Looking at debt to EBITDA, 2.43. So it's below the 3. Another way to think about debt to EBITDA is how many years, if you devoted your earnings before interest, taxes, depreciation, amortization, would it take to pay off that debt? A little less than 2.5 years. So it's not bad. They're not exceptional. They're okay. It's kind of like they get a C+ passing grade. So we are good on the balance sheet. What are analysts saying about this company? 12 of them cover the company. One of them thinks $27 price target, low point 18. So your downside isn't too bad, discounted by 37%. And we've got a company that's going to grow 3%, just barely above inflation, which is consumer staples. It's not a surprise. It's what they do. And we've got earnings per share in 2026 of $1.15. And they're going to expand the profitability better than their growth rate. So I'm going to grow profits by 5%. Last thing I need is share count. How many shares are outstanding for this business? 1,920,000,000 shares outstanding. Okay. All right. So let's take a look at a value for this business. This is a consumer staple. And before I forget, 1 second, let me put OWL down here. We're covering a lot of ground tonight, a lot of valuations. Good. And I'm going to compare this to Kroger. Not exactly the same business, but this is where my consumer staple stocks are. Yeah, Walgreens. That might be even better. All right. Because you find a lot of their product in Walgreens. You also find it in Kroger. So let's park it right below Walgreens. All right. So the ticker was KVUE. And the company name so I'm going to go with the discount rate of 9. Now, a perfect business with high margins and great balance sheet, really well-known business. Right now, I'm going 7.58%. These guys are in a staple industry, but their balance sheet isn't perfect. They're a little lesser known. You obviously see what could happen when a bad story goes out there. So I'm going to go with 9. I think that is what I think the risk in this stock, that should be the compensation that I would want. So trailing 12 months on this stock is nice cash flow number, 1,627,000,000. I'm going to grow that by 5%. And we're going to grow the remaining years by 5%, 1 through 4. And then terminal value is going to grow at 4%. That is fine. When we look at cash, we've got $1,070,000,000 of cash and $8,740,000,000 of debt. Shares outstanding. Okay. So their market cap, their share price is 24% too high. Based on this valuation of their cash flows, growing them at 5%, which is very reasonable. In fact, that might be a tiny bit optimistic, but hitting them with a discount rate that assures that, hey, this isn't a perfect company, has a balance sheet with some debt, 9% discount rate. The net present value of those cash flows, $32.6 billion. Add cash, take away debt. So the business is worth $25 billion based on this valuation model, which is 24% too high. Let's take a look at earnings per share. So the earnings per share is $1.15 in 2026. They're a growing business in a staple industry, hidden with the 12. So they're actually priced 16% too high based on earnings per share. Consumer staple businesses tend to always be like fairly priced, a little bit expensive, a little less expensive, and they just don't move a whole lot. For this stock to move as much as it's been moving is a little surprising. But this one here, just it wouldn't be a buy for me. It would be a sell. There's other consumer staple stocks that I think are pretty good options. I mean, if you're going to go into a company that's selling these necessity like drugs like Tylenol or Zyrtec or mouthwash, you can find pharmaceutical companies like Novo Nordisk, Pfizer. You can even go to smaller caps like Catalyst Pharma, and you have great rates of return there. much better discounts available on those incredible businesses that have high margins. And that would be where my capital will end up versus going into one of these guys. So that's my analysis on Kenvue. Appreciate you asking. Thanks so much for becoming a member. I look forward to more and more questions from you. And we'll take a look at more stocks that you are interested in. All right. So we just finished, I don't know, 7, 8 different valuations. Thanks so much for all the questions. When we do valuations like this, I'll tell you, over the last 30 days, really the last 6 months, the number of really neat small caps, right? Not every small cap is going to look great, but we have found about 10 really good small caps that have done great from an appreciation standpoint. So all these ideas, we look at a number of companies and sometimes we find a really nice diamond. Like, wow, that business looks really good. And the market's not paying attention to it. It's a really good opportunity. So I appreciate the wide kind of scattering of different types of stocks so we could see what's going on out there. What is looking like a good investment? We're dealing with an expensive market. And finding discounted stocks is getting harder and harder because the market is, it's done what it's done. It's let me get out of here and try to get to just the NASDAQ. Oh, look at that. It did it again. How do I get rid? I started using this app. So let's get rid of this. Google Finance came out with its beta, which I like because it has a black screen, and getting to know it as I just demonstrated. But you see that the 5-year on the NASDAQ is just superb. For a whole index to go up 106%, I am not complaining at the rate of return. It's just we're in an expensive market. It gets harder and harder to find discounted stocks as stock prices get more and more expensive. It's logical, right? So that's where we're at. I'm going to put in my email address just so that everybody has it in case you need it. And especially a new member, just email me and then I can know who you are, how to communicate with you, get all the perks that you've signed up for. And again, I appreciate you being a member. Herdo, thanks so much, man. You are awesome, sir. I really appreciate having a very active conversation with you around stocks. Thank you, sir. All right, guys. So we are moving. We covered a lot of ground. I better leave a few stocks to analyze in the morning. We're going to stream tomorrow morning. If you're up for it, I know this is more of the evening crowd, but Daryl and I will be looking at stocks at 9 a.m. Eastern, 6 Pacific tomorrow morning. And then on Thursday for Costco, we're going to be doing an earnings watch party for Costco. And I think start time is 1:45 p.m. Pacific. And we're going to analyze Costco after they announced their earnings. We're going to listen to the management team speak. We're going to continue to talk about Costco and really beat it up and really analyze it and try to get to intrinsic value. I know earlier, I think Kenvue is a staple stock, right? Well, Costco most definitely is a staple stock. Consumer staple, discount stores. And these guys are one of the solid businesses, right? But it's been kind of plateauing. So what's going on with Costco? We're going to take a close look on Thursday. They're going to announce after the market closes, and we're going to analyze this thing every way we can think of. Daryl and I'll do fundamental analysis, and he's going to do the charts. And we're going to take all the questions that come up on Costco. We're probably going to spend 45 minutes on it, maybe an hour. So if you are a Costco investor or interested in Costco, it's going to be a pretty lengthy analysis on Costco. I think it deserves it. $418 billion market cap. It's just a really, really awesome business. I don't get how their market cap's gone up so high, by the way, because their margins are not great. They grow, they keep growing, which is good. But when we get to margins, free cash flow looks good, but not great. And then gross margin, 12.78%, which if you're doing the kind of volume they're doing, that makes sense. It's pretty high. Then we get to profit margin less than 3%. Like, man, not exciting. I've never been a Costco stockholder because I look at these margins and I'm like, I'd rather buy a software company, a pharmaceutical company. I'd rather buy Meta. I'd rather buy really high margin businesses. But Costco is a big investment for a lot of investors. They pay a dividend. And I think it's an important company to cover and analyze. And we'll be doing that on Thursday if you're up for it. So that is it, folks. Thanks so much. It was an awesome stream. Thank you for all your support, your interest in the stream, and look forward to streaming again. We'll stream again on Thursday, of course, in the mornings. Tomorrow morning, as well as Friday morning, I'll be streaming, and I'll stream on the weekends too. So hopefully I'll see you guys on those sessions. Everybody have a good night, and thanks again.